Over the last year, since August 20th, 2021, PayPal has dropped 63.6% again in 1 year. Did it deserve to fall that far? Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. And I'm presenting today my continuing series on growth stocks. I've had a lot of subscribers ask me to look at growth stocks. As I said in my previous video on growth stocks, I prefer more conservative dividend-paying stocks. It fits my personality of investing more. I think it's a lot safer way to go. But as I said in the last video, you can't really deny the value of investing in a good growth stock. I mean, they can generate extraordinary rates of return for you in both the long term as well as even the short term, as we'll see here when we look at them. So I'm going to examine three today that I think are probably three of the most popular or most well-known growth stocks out there. I'm going to look at Meta, aka Facebook, or Meta. I'm going to look at Nvidia, which is also, the gamer, the GPU creator, graphics processing chips. And then I'm going to look at PayPal, the payment processor, and look at what's happened to these three stocks as, over the course of the years, how fast they've grown. And keep in mind, these are all three very young companies. So let's go ahead and get into some of the data here. I've created this little mini version of the portfolio. Facebook or Meta has never really requested a credit rating, but I think they would command at least an A rating or probably higher when you look at the company's financial statements and balance sheet and so on. When you look at Nvidia, it's A rated and PayPal is A minus rated. And these are very high ratings for companies this young. So let's go ahead and let's start with PayPal, which was the one that I covered in the introduction. And, let's look at what's really gone on with the company and what's really happened. And part of what I'm trying to process here, this is a young company. It's only been publicly traded since July of 2015. And you can see it's had a really strong earnings run. Earnings growth has been 27%, 16%, 27%, 27%, 28%, 25%, and 29%. That's for an average of 18.51, including the forecast years. But now if I go ahead and scroll the forecast periods off of that, it still averaged about 18% growth. If I look at different time frames, I see that this has been a double-digit grower. The fair value reference that this would command at that kind of growth would be a PE of about 18. And that's what the orange line on this graph does. So, theoretically, it should be worth about 18 to 20 times earnings. The actual market PE that the market has applied has been 35. And that's the blue line. But now I want to analyze what we're looking at here, because the whole idea here is that we are not with FastGraph, the FastGraph tool, which I'm using here to illustrate these three companies, does not dictate fair value, it reveals it. It creates theoretical valuation reference lines. The orange line, at least, is based on a formula that's discounting cash flows. And then, utilizing that to say, this is what normally you would expect a company with this record of growth to basically be worth. That would be looking at operating earnings or cash flows or any other metrics. We can look at numerous metrics here. But if you look at operating earnings, you can see this company has commanded a very high price earnings ratio, normally of around 35 times earnings. But again, let's analyze that. There were times when it traded at around 27 times earnings, so you need to be aware of that. Then there was times when it traded in 40 and 50 times earnings. You need to be aware of that. And then there were times that it traded, as high as 60 and 70 times earnings and peaked out over 70 times earnings at its peak last year. Now, those are very, very high valuations, and common sense would, dictate that the company would have to grow very, very fast. Keep in mind, the essence of all prudent investing and really all spending, even if you're just purchasing things, you always want to be buying a bargain, because that's where you get the best value for what you're doing. If you're an investor, that's what a value investor is really always thinking about. They're trying to buy something for less than its theoretically intrinsic value and then use that as the margin of safety factor, which I've talked about. Now, with growth stocks, a little bit different mentality. You're thinking about buying the future with growth stocks, and the future is very dynamic because these companies are growing very fast. Look how fast the company's earnings have grown. They went from $1.29 in 2015 and they were over $2.40 by 2018, just 3 years later. And then from 240, they were at $4.60 by 12/20. So, these companies are just compounding earnings growth very quickly. And PayPal was certainly a big success. Now, when you look at performance during this time, even at these high PE ratios, you can see that there was at its, pretty much at its peak, you were looking at returns of 40% a year. Now, it's hard to talk to any investor and saying that this was necessarily, false profits, as I like to call them, because it should have been clearly obvious if you were using any valuation measurement at all, any guide to how stocks should be valued, to how valuable a stream of income is. Let me make that clear. A stock gets its value from the amount of earnings or cash flows that it generates on the shareholder's behalf. Let's go ahead and look at cash flows. Cash flow growth for PayPal has been slightly less, okay? But the point is, that's what gives you the value. How much cash, how much money is this company capable of making you if you were an owner? That's what a shareholder is. Don't forget that. You're actually an owner of the business. If you're a long-term shareholder, that's what the company's worth. And notice here, when I'm looking at operating cash flow, how the company for the first couple of years really traded right in line with its cash flow growth. In this case, is the price to cash flow ratio of 16.1. All right, then we had this period where coming out of COVID, interestingly enough, the stock dropped like most stocks did. But then we had this almost reckless recovery that drove its prices up to ridiculous numbers. That's, pretty high. Now, again, the company did perform well, but, another aspect of growth stock investing, since you're investing in the future, and, investors are always thinking about the future, is to look at sales or revenues, because revenues tend to be what, get people excited. Now, PayPal grew its revenues at a rate of 16.81% per year, and that's including estimated growth, for the next 2 years. Now, the normal price to sales ratio that the market has applied over this time frame has been about 6.8 times sales, almost 7 times sales. Very high price to sales ratio, but that's not totally crazy for a very fast growing companies like this. And what we're looking at here is you can see how the price really tracked that, but then we had this can only be described as a blip or a bubble. Now what happened is the price got dramatically overpriced, okay, and nothing really bad happened to the company's sales. But I do want to remind you, if I go back to operating earnings are expected to drop by 15% this year. So we've had some temporary weakness, possibly in earnings growth, and it was very minimal. The company's not losing money. They're not going out of business. It isn't Armageddon here. But of course, the stock price fell over 60%, as I indicated before. But now the reaction, if you're one that likes price to sales, and although this has a very high price to sales, looks like an overreaction here. But if we go, remember, we're buying the future. So if we go into the future, the company's sales growth is still expected to be over 13%. And that may be a little pessimistic, or a little pessimism worked in. So maybe the old 15 to 16% sales growth is, still looking normal. And their long-term sales growth is expected to be 10%. Now, these are by the analysts that, follow the company at FactSet. There are other analysts that may have higher expectations, but I think these numbers are reasonably realistic if you're, really evaluating it. And, when you look at the analyst scorecard for this company, it's really had a very impeccable record where, the analysts have forecast the sales, plus or minus, little deviations of reality very well. So looking at it from a price to sales point of view, the company actually looks very attractively priced right now if you're a growth stock investor. And this very well may be true. But I think the message I'm trying to get across by going over this is when you see these crazy valuations here, you need to apply the common sense test. Is a company really worth a price to sales of 15? Or if you look at it from a standpoint of earnings growth, is a company really worth 70 times earnings, 69 or 70 times earnings? I mean, the earnings yield at those levels are almost nothing. So, if you own the company and they paid you all their profits, you still wouldn't make any money. I think PayPal is currently trading at a valuation that might make some economic sense. It's, closer to being in alignment with its cash flows. And of course, it looks cheap based on a price to sales. But the real key is, what do you expect the future to be? And that's what you should be making your investment decision on. Now, leaving PayPal and going into Nvidia, which again is the graphic processing chips, this company has had tremendous operating cash flow growth of over 30% a year. And you could see how the stock price really tracked that. It got periods of time where it got expensive, and it, always kind of sort of came back to reality. And then we had this huge run post-COVID where the stock price got crazy again. Everyone got all excited about these high valuations. And once again, we see from peak to trough, we see a 56% drop in the value of this stock in a very short period of time, in, 7 or 8 months, so to speak. And, has the stock now become reasonably priced? Now, if I go to forecasting, analysts are expecting cash flow growth of about 25% a year going forward. That would make Nvidia a little bit expensive here going for the next couple of years, but it wouldn't be crazy. It isn't a crazy valuation like we saw back here. Now, if we apply the same, type of rules, and what I'm showing you here is how to use a tool like FastGraph. When you look at sales, the sales growth is expected to be about 17% a year. If we look at historical sales growth, it's been about 23% a year. Now, this is, really getting to be a relatively large company, $458 billion. There's cryptocurrency issues here and things like that when you're looking at the gaming industry. Requires a lot of research, but you want to be comfortable what you think this company's future might be before you lay your hard-earned money down. But, the reality of it is you'd be so much better off buying a stock like Nvidia when it was inexpensive, like it was, back in 2014 and 15 and 16. All right, moving on, if we go to Meta now, this is one that I think is really very, very interesting. So let's start with operating earnings growth, and let's go ahead and look at the entire life cycle. Like most IPOs that came out, very high PE. The PE was cut in half within the first year, which is very typical. But then since that time, the company grew their earnings at over 28% a year. They had a down year coming into the COVID pandemic, and then it recovered very nicely. Earnings and price moved pretty much in tandem for a couple of years. And then we have this all of a sudden down year, and we're seeing some, subscriber numbers and things that have been, negative for really the first time in the company's history. And of course, they changed their name from Facebook to Meta. They're involved in virtual reality, and they've creating the virtual reality equipment and so on, hardware. And, the company's kind of moving in that direction. They think that's where their future is. Okay, but the stock price has reacted pretty severely to this drop. Now, again, this is a dynamic tool. It allows you to evaluate what's been going on. So if I drop this to 12 years, the earnings growth has actually been higher at 31%. I drop it to 10 years, now all of a sudden earnings growth is only 20%. I drop it to 7 years, now earnings growth is cut almost in half again, it's only 11%. And, if I keep dropping it lower, it's only been 7%. And if I look to the future, analysts are only expecting about 1% earnings growth over the next, couple of years. And the long-term growth rate is expected to be only about 5%. Now, again, that's, different numbers by different analysts and different companies. If we go, for example, to Yahoo estimates, and this is a different set of analysts, Yahoo looks at 7.5% as the next 5-year growth rate, which is in line with the 4.85, but obviously lower. So I can go to the custom, and I can go ahead and I'll just put 8% in, which is rounding off the estimate from Yahoo. And Facebook or Meta would be a pretty good investment now. But the key is, what I want to get across as I've gone through these three companies is you want to be looking at these stocks, what the future holds for them. Don't just make your decisions based on what they've done in the past. Look at, their earnings and their cash flows and of course, what their sales growth has been historically, and whether that sales growth is expected to, continue going forward or not, and then how, inexpensive or expensive the stocks are. I'm not saying that any of these are a bad investment now. In fact, this may be the great opportunity to buy all three of them. But the point is, I want you to be realistic, and I want you to make your investments based on rational thinking and prudence. Anyway, I hope you enjoyed this video. This is Chuck Carnevale, a.k.a. Mr. Valuation, co-founder of FastGraphs, the fundamentals analyzer software tool. Research that I don't know how investors can possibly think about investing their money without it. As far as I'm concerned, growth stock investing is not for the faint of heart, because you can see by looking at all of these three companies, when looking at them from a standpoint of operating earnings, how their prices have dropped dramatically from their all-time highs. And so you want to, keep that in your mind as you're going through this. There's a lot of risk, and there can be a lot of short-term risk. And what you want to do is make sure that you're keeping your prices and earnings in line with each other. And then on top of that, you want to make sure always look to the future. What's the future going to hold? Don't get just completely, biased by the past, what the past has produced. What are they capable of doing in the future? I think that's so critical when you're doing a growth stock investing. I mean, companies like McDonald's grew earnings at 30% a year for decades before they start slowing down to 8 or 10% growth like they have now. Anyway, if you like this video, give me a like, share it with your friends. Please subscribe to the channel, ring the bell, and also take a look at Fast Graphs. What a great tool for you. Anyway, thanks for watching. And this will be the last of the growth stock videos I'm going to do for a while, but I hope you've enjoyed this little short series. Thanks.